Hey everyone, it's Taylor Steele with the Integrated-Equities team. Joining me alongside is Austin Carroll, and we're excited to be out here in Toronto today sitting down with Sasha Choo-Choos to talk about what Greybrook is up to today. Fun fact before we dive into the conversation today, 2 out of the 3 of us here at this table have been to an NHL training camp, and I'll let everyone in the comments guess which 2 of the 3 that is. So thanks a lot for being with us here today, Sasha.
You're welcome. Thanks, guys.
Yeah, thank you.
Happy to be here.
Awesome.
Well, actually, you guys are visiting me, so happy to have you here.
Thanks for bringing the good weather.
No problem.
Yeah, we were just catching up, talking all things Toronto Maple Leafs, the Raptors, catching up on the real estate market here as well. So for those of the viewers who haven't heard about Greybrook in the past, tell us a little bit about who Greybrook is and your role within the organization.
Sure. So we're a private equity investment firm. We invest almost exclusively in ground-up development in the residential sector. So pretty narrow focus, and that's something that started out that way. And then as we've evolved, we decided rather than broaden, we try to get really, really deep in the things that we think we know. My role, I'm the CEO. I'm a co-founder. I have 2 partners, one of whom is a healthcare guy, not even a real estate guy. It was his capital that helped us start the business. My other partner, Peter, is a real estate guy, and the 2 of us effectively co-CEO the business, although he doesn't like calling us co-CEOs. So I'm the CEO of Greybrook Securities, technically, and he's the CEO of Greybrook Realty Partners. We invest across North America, and as I said, as you guys know, Toronto and the GTA and sort of more broadly the Greater Golden Horseshoe is a real big focus for us, and about 65 or 70% of the portfolio's situated there, with the remainder being kind of throughout the U.S. in different cities.
And it's very impressive for us looking in. You work with some of the largest development partners here in Canada and the U.S. How did you come to connect with these different partners?
Well, going back in history to when we started, Elias, who's the gentleman I mentioned, who it was his capital that helped us get started, he had a relationship with a developer here in Toronto called Plaza Corp. And initially he sort of, when he hired Peter and I, today we're equal partners in the business, but at the beginning he kind of hired us to help man some of his capital. He basically said, hey, I want to invest in a development joint venture. It's going to be with these guys, figure it out. And the part of figuring it out was not only participating at the beginning and trying to structure a deal and make it make sense, but then beyond that, it was our first 4 years of existence were in the offices of this developer. So we got to really learn it at a very granular level. We took a lot of what we learned there and made a decision that we felt this was an asset class that investors, particularly individual investors, should have access to, and we thought it was a great risk-reward trade-off. So we basically took the model we developed together with Plaza Corp and decided that if we wanted to become an asset management platform, we had to deliver a little bit of diversification across different operators who have different projects, different expertise. And we took that to another developer, and one thing led to another. And I think the experience we gained with Plaza Corp and their heft as a developer at the time really helped us springboard into other development relationships because we had the credibility of working with Plaza Corp. And I think what set us apart at the time was having a very intimate knowledge of development. So unlike a traditional sort of private equity firm coming from a finance side or a capital market side and really understanding investment as a capital markets participant, we came at it kind of from the other way, right? So we had capital, we had already invested it, and we learned development. So that allowed us to bring an added dimension of value to developers. So it wasn't just about writing a check. It was about writing a check and then also being able to get active in the development and bring to bear everything that we knew as an organization. At the time, it was only a few of us. Today, we have over 100. And I think that's what keeps us competitive and has enabled us to expand with really the biggest and the best developers because, truthfully, they have access to capital, right? If you're a developer of the scale of those we work with, they have their own balance sheets. They have access to many partners who want to invest alongside them. What we have brought to the table that's kind of kept us in the game, so to speak, is really that added dimension of adding value to the actual development process. So when you're out there and we have about 100 projects that are active today, and in multiple markets, we work with all the banks, all the brokers, we're at any given time buying land, opening a sales center, closing a sales center, financing something. That gives you a real real-time knowledge, to put it that way, of what's happening. And that is a huge asset when you're going into these developments with the partners that we have. So we've been very fortunate to be able to build these partnerships. I think it's been mutually beneficial. Our investors get to benefit from the value that we bring, but also the value that the biggest and the best execution brings. And as I've just pointed out, I think that they've got some value out of it as well.
Yeah, and that's a question we get a lot from clients is if they're working with some of the largest developers out there, do they not have capital to go do it themselves? So to hear what the value you bring is very important to share with our clients.
Yeah, the one thing I want to add to that, you guys are capital markets guys, you understand this. The biggest companies in the world access capital markets. That's how they grow, right? So you could be Apple, you could have $1 billion in your bank accounts. At the same time, you're going to access equity capital markets, you're going to access bond markets, because it's an efficient way to grow your own business and it's a good return on your own equity. So developers were no different, really. Many of them, because capital markets wasn't, between players like us and players like yourselves that have really understood this, there weren't a lot. And developers would use their own means primarily. And then people like us would show up and say, hey, listen, here's a better way for you to scale, more efficient, and at the same time, bringing this other added dimension. So I think that once people understand that this is not new, like if you look at corporate America or corporate Canada, you see the biggest companies in the world that they're listed on exchanges, they're raising equity and debt all the time. Mm-hmm. It's just a good way to grow.
And I think the points that you touched on there, we're buying land, we're rezoning land, we're setting up presentation centers, we're building stuff, we're closing down presentation centers. These are all the stages of development that have to go through, but being an investor into Greybrook, you participate alongside the company that's doing all that heavy lifting, whereas you as the investor don't have to be involved in any of that process. So I think that's why a lot of clients like the concept of investing in development without having to do it themselves. And so you talked about Canada, the US. Do you mind drilling down a little bit more some of the areas or the sub-markets within those regions that you guys like?
Yeah, so Canada for us, we have been, for the most part, very local. And that's Southern Ontario based. And our thesis around that really centers around sort of population growth and demographic shift and what's happening in Ontario versus some other provinces. And development is very, it requires political relationships, it requires relationships within communities and a very intricate knowledge of planning. So it's really hard to replicate in multiple different markets unless you have operations set up in multiple different markets. Most of our developers are local, and that's been our strategy. In the US, our partner is a New York-based partner that has operations across the country, and that has enabled us to broaden the strategy. And one thing that we're doing in the US, I think that's a little bit different than what we do in Canada, is effectively purpose-built rental. So what we do in Canada is almost exclusively for sale. So whether it's a home, a townhome, or a condominium, it's somebody who is ultimately buying what you're building and they are the end user owner. In the US, we're buying them for the purposes of renting them. And that's largely driven by legislation in these countries and how it differs and sort of overall the practices within the market. And here, we hear in Canada all the time about we need more rental. And that may be true, but sometimes people ignore the fact that our condo supply is a rental supply. It's just a different ownership structure, whereas opposed to having a pension fund that owns a bunch of units, it's individual micro landlords that make investments in condo units and rent them out, and that's what supplies our condo pool, or rental pool. In the US, it's a little bit different where the composition of ownership is different, and then you have a lot more rental opportunities. So our focus in the US started in South Florida. One of my business partners, Peter, grew up there. So we had a familiarity through him being there in that area. That's where we started to get very comfortable. Our partner, Property Markets Group, PMG, New York-based, operations in Florida. So we started doing deals together there, and then we started expanding our thesis more or less across the Sun Belt and then moving into some other markets subsequent to that, all with a very specific strategy, and that's building, sort of large-scale urban rental buildings for the most part. We do some luxury condominiums as well as housing developments from time to time, but the bulk of our strategy in the US has been in the rental market.
So Greybrook works with some of the largest development partners. You go out there and you supply rental housing or condos, both here in Canada and the US. As an investor, what does that look like for an investor looking to participate with Greybrook?
Well, I think Taylor said it well too. People look to us for a couple of different reasons. Development is not the most typical type of exposure you get as an individual investor. There are great strategies like value add strategies. There are great strategies even in public markets, buying REITs and being able to diversify into real assets, but through less of the manufacturing process and more through the ownership of real estate. So one thing is a new type of exposure for investors. The second thing is it's passive, right? So you said it, I think. It's not, I mean, we do the active component. This is something you can use your RSP or TFSA or any vehicle that you have, corporations, even individually, to invest some capital passively, because a lot of people like to invest in real estate actively, right? Where they buy a unit or they buy something and manage it. This just gives them a different outlet where they're not doing the work. The exposure that investors get, we're not a fund, okay? So what is a little bit unique, and I know that you guys work with others who do it this way, which I think is a really great way to do it, is it's a deal by deal type of thing. So clients can build their own exposure, and of course we're there to give them advice on the type of exposure that is suitable for them. But ultimately they can build their own exposure to different projects of different duration, and that we buy at different stages. Like sometimes we'll buy something that's raw land and we'll move it through the development process right through to completion. Other times the business plan might be just to approve and sell something. Other times it might be already approved and we're just going through the construction process. So it gives people a little bit of a selection, and the way that they participate is passively through any one of these vehicles. And of course, we have a team. You guys yourselves are a team that's an extension of ours that can help clients determine what is appropriate for them. And that's more or less how they participate together with us.
Yeah, it's cool how investors can pick on a deal-by-deal basis, but also in a way sort of create their own fund. They can get a low-rise development, a high-rise townhouse project, something in Ontario, maybe something in the US, and sort of put together their own fund without maybe it being selected for them. And so you talked about 100 projects currently on the go right now. Taking a look at projects from start to finish, what does your track record for completed projects look like? Maybe annualized return,
Sure.
Average hold period, stuff like that?
So we have a little over 20, I think it's about 23 that are completed. These things take a long time, right? The gestation period of these projects, normally you're buying something and by the time all is said and done, from entitlement to approval to sale through construction, it could be a 4 to 7 year or sometimes even longer time frame. So we have over 20 of them that have been completed. Our average hold is about 4.7 years, like very precise numbers. Our average annual return is about 22.3 across the portfolio, and the average equity multiple is about a 2.4, I believe. So that's sort of the metrics. I'd say that the future, the one component I want to draw attention to is, as an active manager and not a developer, our infrastructure is not that of a developer. We have the ability to do what a developer does, and that's how we built out our team. But it's not like we have construction teams that are sitting there waiting in the wings. So what that does is it gives us a degree of flexibility to look at sort of maximizing risk return. So sometimes what that means in plain English is we'll buy a property with an intention to take it right through to completion, but things will change in the market, circumstances, supply, demand for land, and we may make a decision to sell that early and not even build. So about, I'd say 70% of the portfolio has been taken through completion. Some proportion of it, maybe 20 or 30%, has been projects where we've entitled, approved, and sold. On average, that's kind of what it's blended to. I'd say that the expectation we try to set with our clients is that we target a 20% annualized return on an annual basis, and our average duration is about 5 years. As you guys know, you've done enough of these to know yourselves that it's art as much as it is science. So when we stay there, at the beginning, when we try to help people understand the forecast and the plan, the thing that we always caution on is the time frames as it relates to development, because a lot of it is really, and not to be cliche, but like a blank canvas. And at the end of the day, you have to go through a design process, you have to go through a community process to get these things approved, and then ultimately everything else that it entails. And sometimes these things can be on the longer end, but we take everything we know, everything we've kind of had to deal with in process in the municipalities we work within, and build that forecast to be as accurate as it can be. And that's sort of the net result so far through our history, and hopefully that continues on.
It was a fantastic result. Great job.
Yeah, it's been good. I think that one thing people really, when I speak to them, I try to help them understand is that this type of investing in general is a portion of somebody's ultimate, holistic investment strategy, and we do our best to generate these type of returns, and I do expect that to continue going forward. But that's why diversification, I think, is important. So every time we meet somebody new, when they come to us, and usually it's a deal that they see and they say, you know what, I love this deal, I want to invest in this deal. We really try to guide them in the direction of whatever it is that you should be allocating to these alternative real estate strategies. Let's zero in on that, and then let's take that, and as you pointed out, let's sprinkle that over 3 or 4 or 5 different projects over the course of a year that'll give you that diversification. And as much as we like to think that we do a great job, and we will do a great job, it just further minimizes the risk associated with investing, because anything can happen in any one project. I mean, COVID, nobody saw that coming. The delays that resulted, as nobody saw these things coming. So if you're across multiple markets and multiple different product types, it just gives you another layer, and that's something that we try to kind of coach people towards.
Yeah, and I think, looking at companies like yourself, a very impressive track record. It's something that all investors take a look at and is important when evaluating an investment. We're all going in with it with the hopes of having a good track record, good success. So it's something that's very top of the list when looking and evaluating different companies. And we're here in sunny Toronto today. What's the development market look like in Toronto?
We're living through a very unique time, and I find myself saying that 2 years ago, and 2 years before that, and 2 years before that, and then you start to think about it, and you're like, there's always something. It's never, for every person that stands back and looks at the Canadian real estate market and says, well, it's just been great. That may be so on an aggregate over a long period of time, but you're always dealing with something, whether it's legislative changes, whether it's fluctuations in interest rates and affordability, pandemics, high construction costs. You're always dealing with something. So I'd say today is not a lot different from issues we've seen in the past, albeit different types of issues. So today we're dealing with a high interest rate environment, right? Obviously everybody knows that in more expensive cities, whether that's the Vancouvers of the world, the Torontos of the world, Montreal, Calgary, this is a barrier for a lot of buyers. So we've seen a much tamer market than we've seen over the past few years. Having said that, we're starting to see it pick up. And what this tells me is that, I'm not trying to forecast and sitting there saying, okay, well, great. From here, it's all green lights again. I think what it tells me is that there's a real need. And we talk about fundamentals a lot when I speak and when those who work at Greybrook speak. And it almost sounds like a broken record, but what we look for are great fundamentals, where the supply of housing is simply incapable of meeting the demand for that housing, whatever those dynamics are that are driving those two factors. And we have that in the GTA, and I think what we're seeing today is even the perception of interest rates flattening and people having that certainty is getting people to jump back into the market. Not because they're speculating on future appreciation, but because they actually need housing, right? So it's one of these things where volatility, you almost can't predict when you're going to see volatility, because every time throughout my career that I feel like, okay, here's some smooth sailing, B20 comes out or another policy or something, and I've learned to just never try to predict that. Real estate investment, in my mind, should be inherently long-term. People should think about it as long-term, and if you pick markets that have great long-term fundamentals, you can ride out the volatility. And that's something that I hope people understand when they're buying real assets. That's the benefit. And the illiquidity sometimes saves people from themselves. A lot of people lose money in the stock market, and myself included, because emotion gets involved. And when you can just hit a button, it makes it a lot easier when you start getting nervous or uncertain about the future. With real assets, it's not that easy to do. And sometimes people can think of that as a frustration, but ultimately it makes rash decisions when markets get volatile very unlikely. And there's been a lot of times in my career where if I had a button, I would have pushed it. And then I learned that, thank God I didn't push it, right? And sometimes it takes those experiences to be able to understand that. And we've been doing this for just about, this is our 20th year. So ultimately, I feel like investors in this market are recognizing that there is a real need, and we're starting to see life again. And when we do, again, not forecasting, but everything we've lived through the past 12 months, there will be a day of reckoning, because again, when population is growing at the rate that it's growing, and when everything not sold today isn't being built tomorrow, it's only going to add to the supply challenges that we have here in Ontario. And when interest rates start to get back down to more normalized levels, whatever those are, it's certainly not zero, but it's also not, 5 or 4.5 or wherever we stand today. I think that we'll start to see a lot more activity, and I think that puts a lot of solid footing under the market, and ultimately we'll see, price appreciation again, or at the very minimum, price stability. And that's something that I think people that are in my industry focus on, and the perception from an investor's perspective may not be that. We don't rely on forever appreciation. What we rely on is stable margins, right? We're in the production business. So ultimately, prices can never increase as long as I have a sustainable margin to build. And ultimately, if there are no stable margins, then there's nothing built. You don't have housing, and you got a bigger problem. So those market dynamics tend to solve themselves, and we've seen that over the years.
You use the term long-term as well as illiquid. Talk about what the investment process looks like. We've covered sort of the development process and what you guys handle behind the scenes for the investors. If I was an investor and I gave Greybrook $50,000, what does that investment process look like? When can I expect to see distributions? And use the term long growth and illiquid, kind of tie that into the answer, if you wouldn't mind.
Sure, yeah. So depending, again, we've determined that we do things deal by deal. So every deal is going to look somewhat different in terms of its time horizon and ultimate liquidity. Things like housing developments, for example, we just completed one in Hamilton, which is a suburb of Toronto. It's 1,500 homes, or 1,200 or 1,300 homes over the course of 10 years. Well, when you're building housing, once you've gone through the approvals process, it's generally phased, and you're building, call it 100 homes at a time. It may be different, but you're building 100 homes at a time, and you start returning capital after you've sort of completed the first phase. You move on to the second, and you can start distributing. So you tend to see distributions over the course of time, and we lay that out for people. So in this particular case, it's a 10-year long overall horizon. That's our forecast. By year 6, we're starting to see capital repatriation, and then 6 to 10, you're getting distributions fairly regularly. There's other projects that are like high-rise projects where ultimately you're building the whole thing and nobody's moving in until you've built it. That's generally a money in at the beginning, money out at the end. Those can take anywhere between 4 to 6 years depending on what you're building. So once we've determined what the project is, we lay that out for investors so that they understand what to expect from an overall liquidity and time horizon. From there, it's a question of determining suitability, right? I think a big part of why we do things deal by deal is so that we can sit individually with investors and, Austin, your risk tolerances and your time horizon might be very different than Taylor's. I mean, it might be the same because you guys are similar in age, but generally speaking, they can be different across investors. So that is an important part of the process and what people should expect. And we ask a bunch of questions, as you guys do when you do it for us. And it's not to be invasive, it's to make sure that we're doing the right thing for clients and matching them with the right opportunities. So there's that discovery process, and once we've zeroed in on that, making an investment, you're gonna get all of what you should be getting, right? Obviously, presentation materials, you get an offering memorandum that's sort of a prospectus level disclosure. We want everybody to understand what they're getting themselves into. We're here to answer questions. You guys are here to answer questions. And once that decision's been made and an investor's invested, our reporting looks, pretty standard in the industry, I think. We used to be quarterly. It's gone to biannual. It's not because we're lazy. It's because of two things. One, the process of development isn't always lightning fast, right? When you're going through approvals and things, sometimes there's just not enough activity to report on. But more importantly, our reporting process is very exhaustive. So from the day-to-day management of kind of the sausage maker, as I'd call it, extrapolating the information, vetting it, testing all the assumptions, doing that times 100. We do that 2 times a year very comprehensively, and then we do financial audits, or not us, but KPMG or one of, Deloitte, one of the big accounting firms. So once a year audits, 2 times a year annual reporting, access to a Greybrook rep whenever you need. That's kind of what it looks like. And we keep everybody abreast of changes to the plan, because the plan is exactly the way it sounds. It's a plan, it's a forecast, As you live these realities, things happen to you, sometimes better, sometimes worse. We manage them all, and we, through our reporting, will always make sure to level set expectations on either delays or things that come earlier than expected, as well as all of the financial updates that we provide.
You know, we talked a lot about diversification, and typically that strategy wins. If I'm an investor and I'm looking at one project, you know, what are some of the aspects that I might want to look at, whether it's in the suburbs, downtown condo, low rise? You know, how does that factor into maybe the timeline and the type of return profiles?
I think, so what an investor should look at, I think there's a universal way to look at all type of projects. So that would be my first starting point. And it always starts from what it is that my investment objective is. Ultimately, if I can, you know, I have an amount of liquidity and wealth that doesn't, you know, this is something I'm saving for my retirement, that's my objective, and I've got 15 years. Doesn't mean I have to invest in a 15-year deal. It just means that I'm less constrained with what I should be investing in. So I think the what is largely driven by the investor's needs. In terms of the actual investment, I feel like, you know, I get asked this question a lot, and there's in the manufacturing business, to put it to you this way, we have a project here in Yorkville, for those who know Toronto, who's like the, you know, it's the probably the best location, I'd say, I'm a little biased, but the best location in the country for a luxury condominium building. And what we are selling that for might be many, many multiples of what we sell a townhouse in Durham region for, which is a suburb of Toronto. But the margins are sometimes similar, right? So in the manufacturing business, it's all about what margin I make, and there's housing that's required across the board. You need the luxury condominiums just like you need the meat and potatoes townhouses in suburban areas, because there's such a housing need. So we try to really not be too biased toward any one strategy. So if I'm an investor today and I had to pick just one investment, I'd look less about the whether it's a townhouse or a luxury condominium, and look at, you know, how the acquisition metrics look, right? We get really detailed on what we're buying, obviously the price. It's all about your entry point and your structure. And what I mean by structure is sometimes, you know, we always use manageable leverage, and there's people out there that don't. And I think that one thing we pride ourselves on is giving ourselves the ability to wait if we had to. Because as I kind of just said, I don't know what's going to happen in the future, but what I do know is that if I don't have a gun to my head with a giant mortgage that's ticking away by the second, it gives me a lot of optionality to sit back and make the right decision. If it's not the right time to go and sell, then I can sit back and wait. Maybe it's 3 months, maybe it's a year. But with that flexibility, that's the most important thing. So investors really should zero in on the structure. And I always encourage people to do diligence on the manager, right? And when I invest my own capital outside of the things we do, and obviously a heavy portion of my own personal wealth is in my own business, but I evaluate the manager, because I'm not an expert in equities. I'm not an expert in bonds or things like that. I try to evaluate the expertise of the people across the table. So I always encourage investors who want to work with us to, you know, visit if they're local. If they're not, we're happy to share all kinds of information about the firm, everything from our track record to how we look at the world, our processes. Because really, at the end of the day, my philosophy has always been, you don't know what's going to happen in the future. You just hope that whenever it happens, good or bad, it's the right people around the table that are there to deal with it. And so that's how I would direct somebody to look. So I don't know if that's a specific answer to what I would buy today, but that's the truth in terms of how I'd look at it.
You know, you covered so many great points about why investing with Greybrook, the development partners that you work with, the track record, the management teams, the markets that you invest in, the asset classes that you guys are building. All these benefits sound great. What are some of the biggest risks to investing in a group like Greybrook or in the land development space?
I think, you know, honestly, land development, I think I said it when you asked me an earlier question, it's like a blank canvas, right? And zoning bylaws are generally not drafted in the very granular form of you can put a building of exactly this many stories and exactly this many units and this many square feet. It's usually land use, right? You can put mixed use here. It's very broad. So from there, it becomes interpretive in terms of what I think I can achieve. When I buy a piece of land, can I put a 40-story building here? If so, why do I think that? Is there precedent available? Have I done all of my studies that you know, kind of would would support that type of application. So what I've seen in development that makes it risky at times is when you're working with groups that aren't as experienced, that can be very aggressive on their assumptions. As somebody who, I've done this a long time, like I've said, these are all forecasts. And at the end of the day, if you change one number, your forecast can be wildly different. So the question is, how aggressive are your assumptions? And sometimes people are aggressive without even knowing they're aggressive, because it's not an easy thing to be able to understand the market at such a granular level. And that's where the experience comes in of having done a lot of these, having a lot of these. Today when we're modeling hard costs, I don't have to read a third-party research report. We've got 26 projects being built, and we're tendering and we're building, so we know real time what these costs are. That goes into our modeling, right? We talk to economists very regularly in terms of their views on interest rate and the market. That feeds into our model. So all of these things I think are really important. As it relates to how that helps us manage risk, conservative assumptions first and foremost. Second, I think, is the point I made earlier about structure, right? Because you and I can go and buy a piece of land. You can get a 75% mortgage on it. And ultimately, if your 2-year planning window turns into a 4-year planning window, that's going to be a lot more expensive than me going in there with no mortgage, for example, and buying land for all cash. So what we try to do when we acquire things is look at what our window to approvals is, because that's a value inflection point, and that's when lenders are more comfortable lending to land or construction processes can start. So it's all about managing your leverage on the front end and looking at the acquisition metrics. We're very rarely the highest bidder in a process. We very rarely buy in a public process. Our deal flow relies on off-market deals largely, and it's those partnerships that we talked about, the fact that these people are built to go out there and assemble land and knock on doors and work with the farmer for a year and a half or two to come to a deal. And those are the deals that are coming to us. So I think that in development, it can be a very risky investment, and I'm not somebody who takes that lightly. I tell people up front, generically, development can be very risky. The way we do it, we like to try and reduce the world of risks into really one of time and illiquidity because of structure and ultimately not taking undue risks at the beginning. Like, we're not buying things that are zoned as a, amusement park and trying to change that entitlement to a residential neighborhood. Like, we're buying things that are usually entitled. There's a clear pathway to approvals, and we're not overpaying and we're not over leveraging.
Yeah, I think when it comes to risk, you said it a couple of times, is the structure, but also the partners that you're working with. Risks are inevitable, and also there's going to be hiccups here and there. But when you have the right team and management in place, like Greybrook and your guys' partners, investors can fall asleep at night being a passive investor, knowing that you guys are going to be working in their best interest, and have likely been in that situation in the past.
We have. Here's a perfect example. We just lived through a period of time where if you bought something in 2019 or 20 and zoned it, and all of a sudden started selling it through the first couple of years of the pandemic, you would have probably sold at pretty high prices. But you know what else happened? Costs went up 30%. Supply chain bottlenecks, lumber was going haywire, all of these things were happening. At the end of the day, your project economics might still be intact because revenues went up more than costs went up. Having said that, the costs going up drove the overall cost and equity requirement up, right? So you could have successful projects, successful margins. The bank is looking at it and saying, okay, but you also have to put up 20% more equity because the cost of the project has increased. In our structure, we protect investors from that. Once capital goes in as equity, we own what we own, and we can never be diluted. And if there's any change in scope, if there's any change in cost, and if there's any other equity requirement, it's incumbent on the developer in our structure to put that money up on behalf of the project. That's a huge component, right? Because the investor's not 3 years down the road, whether it's of the doing of the development or the market, they're not going to get a call saying, hey, you got to put up more money or else. That is something that is structural, but at the end of the day, that's why it matters to have the scale of developer that we have, right? Because it's one thing to be contractually obliged to write a check. It's another thing to be able to write the check. And that's where in tighter markets with tighter credit conditions, that becomes extremely important. And over the last couple maybe 6 to 12 months, we've seen smaller developers get in trouble. Not because they're not good developers, they just don't have the balance sheet capacity when interest rates have increased significantly or costs have gone up significantly, and all of a sudden the equity requirements are higher. And now they're looking around the table saying, I better go back to my investors. I can't put up that money. That's something that will never happen to us. And the reason is through structure and through the overall caliber of the partner as it relates to their financial resources. And that's something that sometimes I'm asked the question and people say, oh, you pick these big developers because they have great execution, great track record. And I say, yes, those are all the obvious ones. Then it's their own financial capacity, their banking relationships, their balance sheet, because it's the times that you don't expect where that actually comes to be a very important aspect of these relationships. And so that's a structural thing, but it's also who the partners are, as you've said.
Speaking of writing the check, what's next for you guys? You guys buying anything right now? What kind of deals do you guys have in the pipeline for investors in the second half year of 2023?
Yeah, we've got a pretty exciting pipeline. When markets sort of slowed down a year ago, the question I got the most was, okay, so are you guys pausing? And I always thought of it as a bit of a perplexing question because we've talked about the fact this is a long-term business. And I have no concerns about the fundamental health of the markets that we develop in as it relates to the need for housing. So everything I'm buying today is something that is housing online many years from now. So it hasn't really changed our buying strategy. So we have a couple of pretty, I'd say, exciting projects. We have one coming up that's toward the end of the year, which is a condo project here in Toronto. It's, for those who know Toronto, it's at Bloor and Islington, which is right on top of a subway station. It's a more affordable product than what you would typically see in the Toronto core, just by virtue of the fact that it's 15 minutes outside the core, but it's right on a subway line, and this is what people are looking for today. The trade-off is a little further out, accessible to transit, I can buy it a lot cheaper, and in an affordability constrained market, these things are winning. So we have that's upcoming. We have a project that we're looking at in a suburb of Toronto. Well, people from there would not call it a suburb of Toronto, but in the tech triangle out in Cambridge. We have one that we're just finishing up here in Hamilton. You guys are already participating with us. And then we have a one in the US that we're looking at right now in Palm Beach, which is a housing development. South Florida has remained very resilient in the overall downturn that the US has seen. And we have zeroed in on a housing development in sort of a nice area of Palm Beach, and that's on deck too. So the second half of the year should be a nice, diverse set of projects that we have coming.
Awesome. Sounds like you guys are busy. Austin and I were chatting earlier. We said we need to organize an investor tour down to Palm Beach.
Yeah,
here
I was going to say that. I only take those diligence assignments when we go to Miami and Palm Beach.
Exactly. Yeah, it's been great working with Greybrook, and we've had a lot of interest here in Canada. So looking forward to potentially a venture down in the States in that launch.
That'd be great. And we value our partnership, and I'm glad you guys made the time to come out to Toronto and brought the sun with you today.
Yeah, it's been great sitting down, and great to hear what you're up to, what Greybrook's up to, and really appreciate your time here this afternoon. So thank you, Sasha.
Yeah, thanks, Sasha.
Awesome.